What's going on, folks? Welcome back to the channel today. This is Jason. I do these live streams twice a week. I also put out videos. I wanted to talk to you guys about Tesla's Investor Day. And I have an opinion that's probably very, very different than most stock pundits on YouTube. And I'm talking about all the other popular, stock YouTubers and the people who follow Tesla and all that. I completely understand the disappointment with Tesla Investor Day. I am not disappointed at all. And hopefully, as we go through this, I'm going to be able to kind of change your mind a little bit here. But I did take a look at the first few minutes of a couple of different videos from some big YouTubers out there, like Meet Kevin, where they basically threw fits about Investor Day. And Meet Kevin's in particular was just way too emotional for anyone to get over a stock or a single investment. But he's completely wrong about his assessment with Tesla. No, they did not announce any big products. They didn't announce any immediate changes, but they announced a couple of big things in there that I can guarantee you that if you weren't paying attention, don't have a technical background, you probably didn't catch. So the better source of information on any of these big events when it comes to Tesla is not somebody who simply follows the stock. Take a look at whatever Sandy Monroe says. He did a drunk meeting that was literally drunk. He was drinking beer the whole time, and I think it was pretty lit by the time he got on. But did a 35-minute video with his opinion on Investor Day, and he's going to bring up, because of his deep technical knowledge of the auto industry and manufacturing and business, he's going to bring up a lot of points in that video that no one else caught. And these are the things that I was looking at and paying attention to and very impressed with. But I could tell during the presentation that the market was going to hate it. Bram, who's always on my live streams, you were right. The market is absolutely going to hate whatever is said. And Bram, I can already see your your comment on here. You were the one that predicted that no matter what is said, the market is not going to like it, and that was absolutely correct. To be honest with you, I expected even more of a negative reaction from the market. But let's talk about what's going on with Tesla. So, what did they not announce? They didn't announce production date and delivery dates for Cybertruck. They didn't announce a new compact or subcompact vehicle that's going to be under $25,000. What they did announce, though, is, of course, the pathway to that. You're not going to be able to produce a sub $25,000 vehicle that's electric here in the United States. You're going to have to do that somewhere where labor costs are lower. There goes that new Monterey Gigafactory. We know that's happening. If you're not familiar with the geography of northern Mexico, Monterey is basically a manufacturing hub there. You have a well-educated workforce there that's going to be able to, and who probably already works in automobile parts or manufacturing facilities there. It's a great place where you have availability of labor. And one of the big issues with northern Mexico is like there isn't that much availability of labor. Unemployment has been extremely low there for a very, very long time because there's only about 30 million people that live in that entire northern part of Mexico. Most people live in a band through the central part of Mexico where like 80 or 90% of their population lives. I think it's about 80% of the population lives. So northern Mexico is pretty sparsely populated, but that is the most populous region where you're going to find the most amount of people who are trained to work in factories. Okay. The other thing that was mentioned that a lot of people don't understand is the switch over to 48-volt electronics inside of the vehicle. And let's talk about how big this is and the fact that Elon Musk basically just created another industry that Tesla is going to be the leader in. Okay, so the auto industry for more than a century now, all of the internal low voltage electronics have been based on 12-volt systems. And right now, it's not just the problem with Tesla, it's a problem with all automobile manufacturers, is the wiring, the harnesses, the switches, all that stuff has now become a really significant portion of the weight in the vehicle. And that weight in the vehicle of all of that is going to be cut in half. Not the entire vehicle, but the weight of the wiring, the harnesses, the switches, all that stuff, electronics is going to be cut in half by moving to 48 volts. Now, Elon made a very important statement that they are going to design and internally source meaning manufacture all of this equipment. So they will likely end up being able to provide all of this for themselves, and in addition, become a tier 2 supplier to anyone else who wants to make that switch to 48 volts. Now, talk of switching to higher voltage internal wiring for vehicles has been around for a very, very long time, but there hasn't been anyone who's willing to step in there and to become that first tier 2 manufacturer and start distributing, because no one is willing to commit to that design. Now that we have Tesla committing to that design, I expect a lot of automakers and a lot of tier 2 suppliers to try and get into that game. And that's what I think is probably the biggest announcement there that no one really understands. So yeah, and there are a lot of other things involving material science and physics that probably weren't all that well understood by the general public. And also, you could go back and grade Master Plan Part 2 and ask yourself really how much of that has come to fruition. And you're going to say about half of it has not at this point. But we're already on the pathway to doing that. We're already on the pathway to creating, the full-size truck, already on the pathway to creating that $25,000 vehicle. And semis are now being delivered at this point. When you take a look at the overall pathway for Master Plan Part 3, he's not saying that Tesla is going to do all this. He's saying that this is the direction that society is moving, that it's not just, it's going to be expensive. It's going to take decades to do it, but it's entirely feasible, and it's likely to happen based on all of the trends out there in the market so far. So I was enormously, enormously pleased by Investor Day. A lot of what they were saying also about data informing design decisions too, which I made a comment on my YouTube community about that. That was very impressive as well. So the bottom line here is that Tesla is entering into a new manufacturing industry. They're going to be an auto parts supplier. They're going to be probably the first auto parts supplier in that whole arena. They're going to have specifically designed electronic components for the inside of their vehicle that they are sourcing, they are designing, they are manufacturing. Yeah. So, and going off of that, some of the other things that they're doing, of course, which is reducing the complexity, the size, and the cost of silicon carbide wafers and things like that inside of the vehicle. Everything has to do with entering into a new market and margin, expanding margins. Tesla is going to turn into a cash machine, despite the fact that they're probably going to spend $5 or $6 billion getting the Monterey plant off the ground and ramping production. They are going to turn into a cash machine in the next couple of years. And most of that has to do with cumulative efficiencies, meaning a little bit of efficiency here, a little bit of efficiency there. And when it all adds up together, you're looking at much better margins for Tesla. Tesla already has the best margins in the business. And they're still manufacturing 1.5 million, 2 million vehicles a year. Whereas, and they have greater margins than someone in like GM or Ford that makes somewhere between 6 and 8 million vehicles per year. So this is huge news. They are going to be far more profitable than any of the big three automakers are now, than any German automaker is right now, than anyone else on the planet. So this is very, very big news, and probably not what you were expecting to hear. Look, I'm very focused on the engineering and manufacturing efficiencies of Tesla. A lot of what you're hearing when it comes to complaints is people that like the way Tesla technology works, not how it works, right? Not how you get to that point. And how it works and how you get to that point says a lot about the cost efficiencies of the company overall and the amount of money they're going to make, which translates, of course, into higher higher share price and all that stuff. So that is my basic opinion. I was far happier than I expected to be. The one thing that I did not want to see was a share buyback. I think it's a waste of money. Look, guys, a share buyback of $1 billion a quarter. What difference does it actually make to a company that's worth almost $1 trillion, right? And besides that, we're not to the point with Tesla where returning shareholder equity is really something that needs to be done. One of the other stocks I'm going to talk about here in a bit is Salesforce, where they've reached the point in their business growth cycle that ruining shareholder equity probably should be a priority for them. They're looking at compound annual growth with like Salesforce reducing to amounts where that should be a priority. Tesla, with its compound annual growth still around the 50% range, they still need to invest money into expanding their operations and owning all of their supply chain. And they're doing a very, very good job of that. So Michael says, I was lucky enough to sell my Applied Materials shares yesterday as it's gone up 20% in a few days on earnings and down 11% after Elon's announcement yesterday. Yeah, and that had everything to do with the silicon carbide stuff. So, which I think that may be a bit of a panic reaction. There's still going to be plenty of other demand for that, even if the entire auto industry follows Tesla's example. There's still lots and lots of companies that are going to increase the demand for silicon carbide. So yeah, very, very exciting stuff going on with Tesla's Investor Day. And I knew that it was going to flop. Like I knew that the average investor was probably going to get bored with how technical it was. And one of the complaints that I heard was they kept rehashing all of the graphics that they had from previous presentations. And yes, they did. What they really did, though, was kind of pull everything together into a master plan, just like he said he wanted to do, as far as which direction the company goes in and participation in this new economy. One of the things that people tend to forget is that most of the times when we have a technical revolution, it involves a radical realignment of wealth. And many of the ideas that worked before aren't going to work in the future. And most companies will actually fail at making that change. He is setting himself up to be, or Tesla up to be in advance of that change. One of the other things that I really liked about that is that this presentation didn't feature Elon Musk that much. I was very happy that it didn't feature Elon Musk that much. It's no secret that on this channel that I'm probably a lot more critical of Elon than, particularly with his antics surrounding Twitter, than a lot of other YouTubers have been. And I'm happy that he is stepping out of the spotlight a little bit and highlighting how much leadership they actually have in their company, especially technical leadership. And hold on a second here. Man, I know exactly where these advertisements came from. I searched for something like signs of a bull market, and like it's actually advertising these signs right here. So definitely some improvements could be made in AI there. And let me see here. Here was the big statement from one of the biggest bears, right? And the guy, what's the guy name? Gordon Johnson. Gordon Johnson has been a Tesla bear for as long as Tesla has been around. His share price target is $24.33 a share. I can't remember it ever being over $30 a share, but he basically missed the point. Tesla's first analyst day did not, as many speculated for months, reveal a new Tesla model, specify a date for the repeated delay of the Cybertruck, introduce a more affordable EV, or announce anything around the company's past robo-taxi plans. Instead, it was 3 hours of vagaries. He wasn't impressed and would have preferred more financial detail from CFO Coherent about the coming year. Like I said, he missed every single point in that live stream that was done, and so did most people that were looking at this. The biggest takeaway from this is that Tesla is likely to become a tier 2 supplier for the entire auto industry when it comes to new 48 volt electronics, techniques, switches, boards, all of that stuff. So there's a lot involved in that, and I don't expect any return on that for a couple of years. But it looks like it looks like the plans for that are coming sooner rather than later, especially if they're actually coming out with a Cybertruck. So yeah. So Bram says back when I was still flying, aviation moved from 24 to 48 volt systems. Yeah, a lot of that had to do with the length of, how much more electrical use there was, and of course the distance that electric current had to be pushed. My first car was 6 volt. Yeah, so fire away with any questions you guys might have on this about specifics when it came to what I was seeing in that. I just kind of gave you my general impressions of Investor Day, and I realized that not everyone is. Let me see here. Elon was very bad at answering questions, and he obfuscated half the answers and ignored half the other questions. Yeah, but he's always pretty bad at answering questions. And the weird thing is, if you search Elon Musk quotes out there, you get a lot of good ones. But if you watch him like on a live stream just talking, if you watch any of the Joe Rogan, Elon Musk interviews, they're painfully difficult to watch and to listen to at times. Like I think he has a ton of social issues when it comes to actually engaging people in a meaningful manner socially. And like, I'm not going to say, or I'm not going to make any guesses as to what that means in terms of, his place on the ASD scale. But yeah, I do think he's been known to do that for a long time. And some of those questions that were asked were not really answerable, right? He would have to just guess on a lot of those things. So anyway, that is kind of my impressions on Tesla. Most people had much more in the way of an emotional presentation when it came to their reaction with Tesla Investor Day. All right, so moving on here, the other thing I wanted to talk about is China's debt hangover when it comes to provincial debt. This is a growing problem. This is a growing problem that has been hidden because it's not sovereign debt issued by the central government. It is debt that's issued by the provinces. The provincial debt and the sovereign debt combined, they're pretty close to what debt in the U.S. is, and their economy is quite a bit smaller. And they don't have reserve currency status that's going to allow them to sort of print money in order to alleviate some of this pressure from debt. The big issue here is that people are already starting to grade the default risk of different provinces here. If you notice the color coding, this right here is low risk, and this is for the provincial debt. Very little of China right now is showing low default risk. Most of it is showing moderate and high risk. And honestly, these provinces right here along the coast where there's a lot of shipping done, a lot of manufacturing done, these are not the places that I would have expected to have the largest amount of debt, right? Chongqing, on the other hand, it's not a province that I'm incredibly familiar with, but it definitely has the highest risk of debt that's out there. But a lot of this debt, provincial debt, originated from the 2008, 2009 crisis, where it was very difficult for China at that time period to go to the open market and get debt. They pushed it down a level to the provinces. And now the Chinese central government is asking the provinces to pay up on their debt. By 2024 or 2026, in that time range, something like 60% of that debt is coming due in that time period. So this is a massive issue, and will likely require the central government coming in and backstopping the provinces, which is going to be a drag on their economy. And this website, macropolo.org, does digital projection, or does projections on macro economies, and we're looking at high drag on the economy in a number of provinces, even where we see that there's less in the way of default risk. Just the high amounts of debt that they're going to have, and the debt that's going to be refinanced when it comes due at higher interest rates, is probably going to drag on the economy. And there's actually numbers associated with this, but it's too small to see on here. But we are looking at high drag on the economy on some of their most prosperous provinces, and where most of the manufacturing and shipping is done from. And that is a concern when it comes to long-term growth of China. Combine that with their demographic time bomb that's going off right now, their population actually dropping in size, not enough being young people being in the country to actually fill all of the job needs that they have. And yeah, so I'm very concerned with this at this point. This is one of the things that's probably not all that well covered in media or well understood by the general public. If you have a chance, though, you should take a look at that. By the way, in the description, I left a link of the drunk Sandy Munro talk, where he's talking in front of with a panel of people in front of a crowd and drinking the whole time about everything that's going on. And that's probably the loosest I've ever seen him. And I'd like to have more drunk Sandy Monroe around to have talks about technical issues. That was actually kind of fun. But yeah, so basically, Macro Polo states in here, this is why we at Macro Polo sifted through 10 years of financial reports from more than 2,000 local government, I forget what it's called, financing vehicles, and created both the default risk indicator and the debt drag indicator. First, a new indicator aims to measure and rank each region's local government finance vehicle default risk, and the second, an updated indicator measures how much existing debt drags on the local economy. So take a look at this article. It's actually pretty short, and I think it's pretty important to understand global economy and what that's going to do. So yeah. I do believe Elon said he had Asperger's on SNL, not as a joke. Wouldn't surprise me at all. That just simply wouldn't surprise me at all. I think that's, yeah, I'm not a psychiatrist or psychologist or whoever diagnoses that, so I'm not going to, but I do think that is kind of the case there. Yeah, drunk Sandy in vino veritas. Yes. So a stock that I don't talk about very much, but probably should be on your radar, since they make up a significant portion of the S&P 500 at this point, or the NASDAQ. I don't remember. They may be on both. I don't know. But it's Salesforce. They're an absolute monster. When I've been talking lately about companies delivering earnings that are not as bad as we expected, this is not one of those cases. This was not as bad as we expected. This was a blow things out of the water in terms of expectations. Now, put this in a context, though, they did reduce their forward guidance a little bit at the beginning of the year, and they've blown that away so far. But the big announcement here really is what they are talking about going from 2022 to 2026 is 13% compound annual growth, which means that their growth has slowed down as they've gotten massive, which is to be expected. But 13% compound annual growth as an expectation is not unreasonable by any means. But the big announcement here is that as compound growth has slowed, Salesforce is going to put some effort towards returning shareholder equity in the form of stock buybacks. I think that the market probably believes that a dividend for Salesforce is not that far away, meaning 2 to 3 years from now, Salesforce will probably start paying a small dividend. And at that point, you start evaluating it on a dividend growth basis, because I think 13% compound annual growth kind of means that this company has reached maturity, and we're going to see more linear growth out of it between now and the end of the decade. So that's kind of the big deal. But in terms, let's see if there's anything else here. Yeah. So and the big thing was annual recurring revenue growth. This is the big thing. We're looking at annual recurring revenue growth growing from full year of 2007 to 47 times growth. Now it's about 1.2% growth, so about 20% growth just in the last year. They're predicting 13% growth kind of from here on out. And like I said, this is the big sign for folks that have been shareholders for a very long time that are looking for return of equity. That's starting to come. And not all share buybacks are evil. This is something that I discussed in one of my earlier videos, that not our share buybacks are equal whatsoever. This is another one of those cases where Salesforce is not the growth company that it was. Its opportunities for growth, they're not limited, but they're not going to be as explosive as they were before. So at this point right now, they have about $3.8 billion in annual recurring revenue. They've got a diversified income stream as well. And you're looking at margins, which are in the, I think, low 20s right now, mid 20s right now, expanding to 30% by 2025, or by 2024 was the estimate. Geographic expansion is untapped, total addressable market, potentially driving new opportunities. So 21% of America, of their revenues, are coming from annual recurring revenue. And 27% right now on an international basis. So this is actually kind of like Huge news compared to what was expected. Once again, though, pay attention to what was expected. They themselves lowered their expected earnings or their earnings projections, I think at the beginning of the year, maybe the end of last year, and they've just kind of spanked that. But they spanked it in a way that would have spanked their original earnings estimates. So, yep. Anyway, that is all I'm going to cover with Salesforce. And that is the material that I have today. I'm open to questions if you guys have any. Did want to take a quick look at the market because I didn't even see where it closed. Let's see here. It looks like, okay, so good day on the market, despite the fact that the 10-year treasury has touched 4%. This is where the 10-year treasury touch 4% is pretty much where I expect the market to start having trouble making upward gains. There's a lot of money right now that's leaving the market. That's been evident since about June. Initially, that money leaving the market wasn't going towards fixed income. At this point right now, I think we can confidently say that money is going into fixed income. With the 10-year treasury at 4%, there's a lot of investors out there saying that I can get 4% with zero risk, or I can invest in the market with a chance of making better than 4%. But and let's be reminded of something. You're not buying 10-year treasuries with the intention of holding them for 10 years. You're buying 10-year treasuries because of current yield and the possibility of some gain if interest rates decline. You don't hold them for the entire 10 years. Most fixed income funds are trading in and out of these bonds all the time. But we are seeing probably institutional money rebalance towards fixed income at this point. And that's going to continue for as long as the 10-year treasury is in that 4% range, which limits, I think, how much rally we're going to see in the market. I think that the market is going to be in a band between, at worst, 3,600, but probably 3,800 for the S&P 500, and no more than, say, 4,200 for the next several months. And if you watched my video earlier this morning that I released, I talked about the 6 signs of market doom, which the 6 signs of market doom are actually when you have the signal to invest. That is when your potential for profits are actually the highest. And those are nowhere near as pessimistic as I would like them to be at this point if I had a large amount of money to commit. And I don't at this point. So I wish I did, but and not that I would do it at this point either. I would probably hang on to that. But anyway, so those are my short sort of things to say about Tesla, about China's debt hangover crisis here, and about Salesforce. The only things I had to cover today. I'm surprised I didn't get any more questions on Tesla, but let me know what you guys are thinking. If not, I am going to call this one a day. I realize it's shorter than my normal live streams, but yeah. Okay, guys. So thank you very much for attending today. I will be back on Monday, and I will see you then.